Welcome to the 3 in 10 podcast. I'm Scott Slayton, partner and chief strategist at Capital Creek Partners. In each episode, I'll give my brief perspective on 3 things we think market participants need to know this week, and we get it all done in 10 minutes or less. For additional resources and analysis, please visit our website at capitalcreek.com. Welcome to the 3 in 10 podcast for Friday, November 7th, 2025. We're recording at 12 p.m. Eastern Standard Time. So here's your starting lineup. Number 1, the data desert. We really have had a paucity of government data for over a month now. We found some interesting things in data that were reported this week outside of the government. Number 2, Apollo earnings, where we found some timely comments from Mark Rowan, CEO Mark Rowan. And number 3, are we in a new digital asset winter with Bitcoin down over 20% in a little more than a month? So back to number 1, the data desert. We got the ISM manufacturing and services indices for October. These are always key reports that we like to focus on. We think they're cutting edge leading indicators. And the ISM manufacturing continued in contraction for the 8th consecutive month. It was disappointing relative to expectations. The good news is prices paid fell from 62 to 58. New orders ticked up modestly to almost 49. And we found the services index to be even more interesting and certainly more upbeat. The services number printed 52.4 versus a 51 estimate and a 50 prior, solidly in expansion, well over 50. New orders and business activity were both strong. Interesting, employment was weak in the services survey. Prices paid in services rose to a 3-year high. This is a concern. Pricing pressure in services continues unabated. I think it's becoming structural in nature and something the Fed has got to be concerned about. This is the fastest service expansion by way of this survey in the last 8 months. So when I boil it down, manufacturing is sluggish and services remain robust. Perhaps even more interesting was the University of Michigan consumer sentiment data, which printed way below expectations for the headline and for current conditions. Current conditions were 52.3 versus a 59 estimate, big miss, and a 58.6 prior. So current conditions at 52.3 is the lowest in the history of the data, going all the way back to 1977. That's quite something when you're approaching 50 years of data, and this is the lowest print we've ever seen. The 1-year inflation expectation as part of this survey ticked up from 4.6 to 4.7. But I think the key point here is that consumers sense more inflation than we see in the data. As Wall Street people, we focus on the rate of increase in inflation, but consumers focus on price levels. How high are these prices? And I think they harken back to pre-COVID days and they see prices up 30+%, and it really unnerves them. And the November 4th election earlier this week, I think, reflected frustration with continued high prices. That was abundant in the exit polls. And these data, I think, also reflect continued weakness in the labor market and uncertainty and fear amongst consumers that labor market weakness, of course, causes. So when we're triangulating and we're looking at the U.S. consumer, the low-end consumer is really under pressure. The high-end consumer is just fine and is the most important part of U.S. consumption, but the low end, the middle to the low end is struggling, and we see it in these confidence data. Now, back to Apollo. We want to listen to everything that Mark Rowan says because we think he may be the single best CEO in all of Wall Street. And what Mark told us in his third quarter earnings comments were that Apollo is in risk reduction mode. Quote unquote, we see investors moving out of rich equity into more attractive credit. he and Jim Zelter said they're preaching top of the capital structure, no PIK, and less software origination. Mark said that demand for capital has never been stronger, not just in the US, but globally. It's being driven by a retirement crisis, the demand for alternative products to increasingly concentrated and correlated public index products, and it's being driven most importantly by the need to finance an industrial renaissance that's occurring in energy because of climate transition, infrastructure, data centers, and defense. So the demand for credit has some major tailwinds here. And Apollo is in a great sweet spot to be able to participate in those three tailwinds. Mark said that he's laser focused, as always, on origination. Apollo has thousands of individuals whose focus is to originate credit. And the long-term Apollo mantra of originate credit with an excess return per unit of risk featured prominently in this conference call. Mark asked three rhetorical questions. Are assets cheap? His answer was unequivocally no. Will long rates go down significantly from here? Unequivocally no. And is geopolitical risk tilted to the upside? Yes. He said something interesting about inflation. Most of what he sees in the world and what we're doing is inflationary. So his response to those three rhetorical questions in an inflationary world is take risk down. Now, finally, number three, are we in a digital asset winter? Well, there are signs of flagging liquidity, and Bitcoin is probably the best canary in the coal mine for liquidity. And when it starts to flag, Bitcoin goes down. And we've seen some stress in money markets. We think that's why QT ended at the last Fed meeting. And we realized that tax day in October 15th hit. So there were some things that have taken money out of the system. And even the government shutdown has allowed the Treasury General account to replenish and get bigger and bigger because a lot of that money is not being paid out. That's going to change, however, though, when the shutdown ends. And we think this shutdown ends within the next week or two. We think the Fed is highly likely to cut in December by another 25 basis points. And we also know from watching China M1 figures that liquidity is gushing in China to offset the property bust, to underpin the equity bull market there, and to help the Chinese consumer. And we don't see this ending anytime soon. Historically, November has been the very best seasonal month for Bitcoin going back all the way to 2009. We know that institutional adoption is continuing because we see the ETFs continuing to grow, and digital assets are becoming mainstream in part because they've performed so well over the last 15 years. Volatile, yes, but overall have performed really well. So with Bitcoin correcting 22% since peaking on October 6th, we're right at 100,000, which technically looks like good support. And so we think we are not heading toward a digital asset winter. We think this is a correction within a continuing bull market for digital assets. So as we always say, do the work, endure the pain of gain, and have investment courage.
The information in this podcast is educational and general in nature and does not take into consideration your personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategy or investment may be suitable for you, consult the appropriate qualified professional before making any final decision.